Hi everybody, this is Hustle Hub. I'm Giacomo, and today we are with Jordan Lambert. He's a CFA chartered from Convequity. Today we're going to talk about Silicon Valley Bank and how it could affect the market as a whole. In the previous video, we talked about the trends in cybersecurity and how the cybersecurity sector is consolidating, investors choosing less risky assets, going down the risk ladder. So make sure to check it out because it's absolutely complementary to today's video. And you can also access the DCFs that Jordan has made. And so you can see how he evaluates cybersecurity stocks. On top of that, make sure to subscribe because Jordan is going to make an analysis on CloudFlare that is coming up soon. So make sure to subscribe so that you see it as soon as we publish it. So without further ado, Jordan, introduce yourself and let's get into the video.
Okay, well, thanks, Giacomo, for having me back on your channel. So we thought it would be useful for viewers to do a follow-on video, a follow-on from the previous video where we did a presentation where we basically outlined our thesis for the cybersecurity industry. The kind of principles behind the thesis of the cybersecurity industry and where it's going to go is that it's going to consolidate going forward. We discussed how it's at peak fragmentation, and really the only way to generate significant value for organizations acquiring cybersecurity services in the future is for there to be a degree of consolidation. And that consolidation was at a high level is going to come from two areas. The demand side, which is the demand from kind of chief information security officers and security operations teams that are currently managing, potentially 50 or even more individual solutions and different vendors within managing their security operations, and it's becoming very difficult to manage. There are platform vendors that have emerged now to provide some consolidation, so they don't have to manage 50 or so different vendors, and they can just have one, two, or just a few vendors to manage. And those platform vendors are the likes of Palo Alto Networks and Fortinet, and these are the high-profile cybersecurity names. And what these platform vendors can do is help organizations consolidate to fewer vendors, fewer solutions, simplify operations, lower costs, eliminate the blind spots, and increase visibility, all of which is very, very important in the current climate of cyber attacks, which are increasing in sophistication and also velocity. So that's kind of the demand side of the thesis, why cybersecurity seems primed to consolidate. The other aspect is the funding supply side. So in the we won't go into too much detail, but if viewers can check out the previous presentation. But on the funding supply side, well, basically in the last few years, we've seen a surge in new startups, especially in cloud security. And so these more startups are competing with each other. And when times were good, that was okay. But because of the economic deterioration in the last kind of 12 to 18 months, these startups are experiencing decelerating growth or sometimes flat growth. And they are experiencing lower cash flows. They're about to come to the market and go through another round of fundraising, but venture capitalists are de-risking. They are slowing down their investment pace, and they're not really in a risky mood to be investing at the pace that there was during the pandemic. So many of these, particularly the early stage startups, well, the thesis was that they're going to be running out of cash very, very soon, and they're not going to be able to raise the funds that they would hope. And then, so we presented this in early February or mid-February, and then lo and behold, the latest development has been Silicon Valley Bank has collapsed. And so we thought, Giacomo and myself thought we'd do a quick video just to explain the significance in how it relates to this cybersecurity industry thesis and how it flows through to a very bullish case for Palo Alto Networks, Fortinet, and other high-profile cybersecurity names. So Silicon Valley Bank was integral to the financial ecosystem of the technology startup scene. In many ways, they operate like a conventional bank, or should I say operated as a conventional bank, because we did wound up on Friday. The regulators basically ordered them into receivership. So they did operate as a conventional bank in some regards, but they did have a big focus on financing startups and venture capitalists that are invested in these startups, providing various financial services, taking customer deposits from these startups, payroll services, the credit lines, stuff like that, but also loans as well. So they are, well, the 16th largest, we're the 16th largest bank in the US and the largest of its kind serving the technology sector. And as many of you have probably found out, that they folded on Friday. So basically, the financing for these startups is even worse than it was prior. The startups, the money that they have at Silicon Bank is going to be made whole by the measures put in place by the Federal Deposit Insurance Corporation and selling some of SVB's assets. But in terms of the financing element, that is just going to be completely dried up. So yeah, it's very supportive for that thesis in terms of not just cybersecurity, but the SaaS, software as a service market as a whole, beginning to consolidate. And it's not all good. It's kind of bullish for the stocks that we particularly like, but it's really bad for the economy generally, because many of these early stage startups were going to be innovators of the future, So yeah. It is quite sad, but that's the situation we're in right now.
Okay. So you talked about how this situation could strengthen the thesis of consolidation, and we've seen before that monetary policy is making interest rates rise, therefore the risk premium is lower. So can you tell us a bit how it could affect tech companies as a whole? Is it consolidation? What else do you see aside from that? Do you see more M&As? I don't know, for example, market leaders buying small startups, the ones that are left with little cash. What are the dynamics that you see coming in the markets?
Yeah, good question. Well, there's kind of various ways it could unfold from here. I mean, there could be opportunities for M&A. The likes of Fortinet, Palo Alto Networks could come in. These, because they're the later stage startups that have more cash, and obviously the public names that are quite cash rich, have high cash balances, they can swoop in and maybe take advantage of the situation. However, it's possible that things are going to get worse before anything like that happens. It's whether or not a contagion spirals, right? So, I mean, anything that has systemic potential like this, even though Silicon Valley Bank did, it happened very, very quickly. It was only on Wednesday that they made an announcement that they was going to sell some of their treasuries, their mortgage backed securities to be specific, in order to provide liquidity. And then there's also going to do some equity raising there, offering out some shares. Investors didn't like that, and the stock started falling. Well, what happened was investors basically told because everyone in Silicon Valley is very closely connected. Investors told their startup portfolio companies to quickly withdraw funds out of Silicon Bank. And on Thursday alone, $42 billion worth was withdrawn from Silicon Valley Bank. And without that, Silicon Valley Bank would have been okay. They was just about liquid enough, their assets were higher than their liabilities. But because of this fear, this run on the bank, it actually turned a relatively minor liquidity issue into an insolvent issue, right? Because then they literally didn't have enough to cover their finance obligations. So that then they got wound up on Friday. So that happened very, very quickly. But kind of the ramifications of all this is going to play itself out over a number of months in probably various different ways. You might get, even though the FDIC has vowed to make every customer's account whole again, in terms of deposits that they have with Silicon Valley Bank, they've got about 130 billion at the FDIC, and also they can sell some of SVB's assets to cover any shortfall. So customers in that regard, startups in that regard are okay. They can make payroll, they can pay their bills. HSBC have actually bought for £1. They actually bought that division of SVB in order to keep those services continuing for startups. But it's very likely there's still going to be some liquidity issues for these startups. It could be like a bit here, a bit there, where the economy, because of all this uncertainty, deteriorates a little further, and then startups experience even more of a deceleration in growth, a drop in cash flow. They need to withdraw even more funds from their customer deposit accounts. And then you really start to get a liquidity crunch, but it's going to happen in a piecemeal fashion over many, many months. Not all startups are going to go through this at the same time. And then not all banks are going to go through this at the same time. So, but the banks, so yeah, it's difficult without having a crystal ball and see how it's all going to play out. But at the moment, the banks that seem to be very vulnerable are the ones that maybe have a similar risk profile to Silicon Valley Bank, but probably not in terms of the lending, but in terms of their assets is probably the most important thing to consider, because Silicon Valley Bank, well, a few years ago, when when rates were near zero, they bought about $80 billion worth of mortgage backed securities, right? And these are very, very sensitive to rate changes. Yeah, especially there is some negative convexity in MBS, but it's not very good when rates go up, because the value of them will fall by a greater amount than kind of comparable standard fixed coupon bonds, right? Because you essentially got the prepayment element involved in there. So that's quite unusual to think that Silicon Valley Bank would have such a huge amount of MBS, but we did. So anyway, rates have gone up quite steeply in the last 18 months, and the value of those MBS has fallen quite a lot. And when customers started to withdraw their funds from SVP, my understanding is they were just kind of ordinarily withdrawing funds, but SVB didn't have enough liquidity to allow those funds, so that's why they had to sell their MBS. But because the MBS had fallen by so much, they had actually made a 1.8 billion loss on their MBSs, and that's essentially what triggered the run of the bank. Yeah, so it's like, these other banks, do they have this? I'm suspecting, I've not dived into each of these banks, but it looks like the ones like First Republic and Western Alliance and PacWest experienced 40, 50, 60% drops in their stock price yesterday may have similar assets on their balance sheet that have been exposed to the rising rate environment, and that will mean they potentially could have a liquidity crisis. The thing is, though, the Fed, the FDIC, and the Treasury have come out and said, look, we are going to support all federally insured financial institutions, no matter what. There's unlimited funding here. They created a bank term financing program, which will provide emergency one-year loans for any institution that is feeling the pressure as customers may begin withdrawing their funds. So there's that, and I don't believe there's a ceiling on that. And there's other assurances that the government has made, but there is this contagion spreading. And it's interesting because the contagion could be, if you're basing it pure on financials, it could be isolated just to SVB, but it's the sentiment that could drive this contagion. Because as we kind of spoke offline, Giacomo, the SVB is not interconnected and embroiled with a complex financial instruments like Lehman's was back in 2008.
Yeah,
it's very, very different. So
one thing that I would like to ask you is just to have a perspective on the scale of this thing, because some people are talking about, is this a new Lehman Brothers? So you said probably not. It's quite unlikely, but we see some contagion. Maybe, for example, yesterday we've seen the credit default swaps on Credit Suisse increase quite dramatically. So even if this is a smaller situation, could this spread out just because of panic in the market?
Yeah, absolutely. It could do, and it is already, right? But it's a bit of a complex. It's not as complicated as GFC, but there are some other components. I mean, the regulators closed down Signature Bank on Sunday, which was a bank involved in crypto dealing, and also Silvergate Capital Bank was closed down last week because they was involved in crypto lending, etc. So there's there are some components that might be kind of mechanically systemic, I would describe it as, but largely with Silicon Valley Bank, it looks like it could be isolated. But yeah, it's that fear is spreading. And yes, the measures in place at the moment can deal with the Silicon Valley Bank situation and make everybody customers account whole again. But if there's going to be a run on First Republic Bank and these other banks, well, the measures put in place at the moment will not be enough. It's only the word of the Fed and the Treasury, right?
Exactly.
It's only their word.
Yeah, I wanted to talk about this because, for example, the S&P 500 yesterday didn't take that big beating that we've seen in the banking sector specifically. Is that because some market players are expecting the interest rates not to rise as we expected previously?
Yeah, I think. Yes, I think there's some of that. These events is likely to make the Fed postpone somewhat in any further interest rate hikes. Obviously, they are tempted to because inflation is still very sticky at elevated levels. But I think the consensus now is that they are going to at least just keep rates even for some time and see how all this plays out, because it would be just well, an increase in rates from here could literally tip one of these banks over the edge again, and it could trigger another Silicon Valley Bank situation because they're so exposed to the interest rates. So that's what the real cause is at the moment, is this spike in interest rates, from near zero to nearly 5% in the last 12 months, and it's really affected the assets of the value of treasuries on these banks' balance sheets. So but even without that, Silicon Valley Bank, they made a $1.8 billion loss, which is huge. But if it wasn't for the run of the bank, they would have been okay.
Yeah, and banks are really weird business where they're worth just as much as they're worth as the trust that people have in them.
Exactly.
When the trust in them is over, the game is over for banks, right?
Yeah, absolutely. I think all eyes are always on the Fed anyway, but even more so now. I think they have a meeting sometime in March, but it's likely they'll keep rates the same, unchanged. But then I guess the first order derivative is trying to assess where inflation is going to go, right? Because the Fed are in bind, because if inflation carries on going higher, then that is a very challenging situation to be in. I mean, my take on inflation is we have seen peak inflation, and obviously the ongoing war with Russia, Ukraine isn't helping inflation, but there's various other factors that are kind of helping inflation ease. So the supply chains have the disruptions in the supply chains, the disconnects have eased up, uncertainty like this in the economy will definitely temper consumer spending. Eventually, it will start to hit confidence. So we may see inflation trickle down a little bit from here, but who knows really? Who knows? I don't think, not many people thought that inflation would go to these levels like 12, 18 months ago. So
and it depends on where you look. If you look at Eastern Europe, they're more like above 20% inflation, like Hungary, Poland, the Baltic states, and so on. So
absolutely,
there are certain states that are suffering very much the situation right now. So talking about the cybersecurity sector, the thing that you specialize on, we talked about consolidation. So you talked about the ones that you see benefiting from this situation. What are the other consequences that you see in the near future for the cybersecurity sector, and could that reverse if monetary policy would have to change because of the tough situation in the markets?
Right, good question. Well, whether this contagion continues and it forces the Fed to hold off on rising rates and even reverse its monetary policy, or whether it kind of just ends tomorrow, and SVB was an isolated case, and the other few were also isolated, and it doesn't get any further. There's still going to be a dry up in financing for these startups, and it's the early stage startups which are higher in number, which will need financing more than the late stage and the public names. So regardless of whether it's a systemic contagion or whether it ends tomorrow, what's happened with SVB is going to impact financing, and some will get wiped out. A lot will get wiped out. Again, just to reiterate, that's bullish for the likes of Palo Alto Networks, especially as they compete against thousands of startups in the cloud security space. And it's bullish because it means that the industry is going to consolidate. There's Palo Alto Networks will be able to gain more market share. because unbelievably, cybersecurity is worth about $150 billion, $160 billion per year. Palo Alto Networks has, probably about 3% market share of that, despite being the biggest pure play cybersecurity name. And just gives you an indication of how fragmented the space is. So if the startup, I don't know any figures particularly, but if the small startups are taking up a big chunk of our market share and now they are gone, of course there'll be some that replace them, but not immediately. And that's very good news for Palo Alto Networks. That can fill the void there because they have such a broad security platform. So yeah, that's very, very good news for, well, I'm not going to say it's good news, but it's bullish for Palo Alto Networks. So yeah, viewers should, for details, take a look at the previous video where I present that thesis in full. And going forward on Giacomo's channel on Hustle Hub, we're going to be presenting investment thesis for CloudFlare, kind of just diving into CloudFlare and CloudFlare against some key competitors. It's like kind of the next in the next episode of this series of cybersecurity related content we're going to produce.
Yeah, and last time we've talked about the fact that probably the Vision Fund era is over. Now that also the Silicon Valley Bank era is over, the thesis that you talked about last time is even stronger, right?
Yeah, absolutely. I mean, in that previous video, we didn't actually mention Silicon Valley Bank. I mean, not many people would have kind of realized it was such a red flag. It's not in our kind of specialist area of research neither, but it definitely supports the thesis that we outlined in regards to cybersecurity.
Okay, so thank you, Jordan, for this video today. Make sure to check out the other video that we did with him and subscribe to the channel for the CloudFlare analysis that is coming up. This is it for today. I'm Giacomo. This is Hustle Hub. See you next time.